America lost 23,000 payroll jobs in July, and the S&P 500 celebrated with a record close. Wall Street saw a weak jobs report and apparently found the confetti drawer, but the market was not cheering unemployment. It was trading the Federal Reserve reaction to the labor data. The Labor Department said non-farm payrolls fell by 23,000, while the unemployment rate slipped to 4.1%. May and June were revised lower by a combined 103,000 jobs. Economists surveyed by Reuters had expected 80,000 jobs to be added. Normally, weaker hiring can threaten growth, consumer spending, and corporate profits. But this market has worried that a hot economy could force the Fed to raise rates again. Before the report, traders put the September hike probability near 55%. After the report, that probability fell to about 44%, down from 67% a week earlier. Lower hike expectations helped pull Treasury yields down and made expensive stocks easier to justify. The 10-year Treasury yield was around 4.64%, while the Nasdaq jumped 1.3%. This is the part where bad news becomes good news and shows up wearing the same cheap suit. Lower yields can support stock valuations because future earnings are discounted less aggressively. But lower yields alone do not explain the S&P 500 record. Corporate earnings provided the cushion, with Reuters reporting that 85.1% of reporting S&P 500 companies topped analyst expectations. So investors got softer labor data without immediately pricing an earnings recession. They wanted the job market to cool, not fall through the floor. Wall Street's dream is weirdly specific, weak enough to restrain the Fed, strong enough to keep profits alive. That is why this rally already has an expiration date attached. July CPI arrives Wednesday, August 12th, and it can rewrite the rate story. Hot inflation could revive hike odds, push yields higher, and turn Friday's confetti into cleanup duty. Cooler inflation, contained yields, and resilient earnings would keep the current setup intact. Watch yields first, because price is surface and the rate liquidity reaction is the message underneath. If yields stay contained and earnings hold, the record high narrative can survive. If labor weakness starts damaging profits, bad news stops being good news quickly. The market is not celebrating job losses, it is celebrating the possibility that the Fed does less. For now, Wall Street's resume reads, weak jobs, strong profits, lower yields, somehow promoted.